Hi, this is Matt Stead, financial advisor at Sachetta Callahan, and today I wanted to talk to you about student loans, specifically what's going on with student loans as it relates to this new CARES Act legislation. First and foremost, I want to say that everything I talk about is going to apply to federal student loans, so this includes direct Stafford loans, Perkins loans, basically anything issued through the Department of Education. If you have private student loans, I'd recommend reaching out to those lenders and those banks and checking in to see what they're doing, because it may vary from what I talk about in this video. So this new CARES Act legislation essentially did two main things. First, it placed all federal loans in temporary administrative forbearance, which is essentially a fancy way of saying all automatic payments have been paused on these loans. In addition to that, they also dropped interest rates on all of these loans to 0%. And both of those things remain in effect until September 30th of 2020. So if you're wondering, what should I do with this information? How does it affect me? I would say there are three, routes we can take here. First and foremost, if you're struggling right now financially, if you were laid off, if you were furloughed because of this crisis, use that money and help yourself and help your family get through this time. This was sort of the intent and the spirit behind the law in the first place. So hopefully that should take some financial stress off your shoulders right now. The other two approaches are for people who are sort of just chugging along financially and not much has changed in regards to their finances. And the first thing you could do for these people is just continue to pay the loan. Because of the 0% interest rate over the next 6 months, you're going to save a lot on interest over the lifetime of the loan. And just to give you a brief example, if you had 10 years remaining on your loan and a $30,000 balance, and before it was dropped to zero, you were at 5% interest rate, you could stand to save over $1,200 over the life of the loan if you just continue to pay it like you were. The other thing that, people who aren't struggling too much right now could do is use it for something else. But I'd caveat that by saying, use it constructively. Don't just roll it into your discretionary monthly spending. Use it for something like paying down other high interest debt, potentially building up an emergency fund, or, contribute more to your retirement accounts right now, to your 401k, to your IRA. And this could be a great time to do that, especially where the market's sort of at a much lower point than it was a few months ago. I would say though, it's really going to depend on your situation and how it fits into your financial plan as a whole. So I'd reach out to us and, we can work through it together to see what the best approach for you would be. For now, take care. I hope you're staying happy and healthy through these difficult times, and we're really looking forward to seeing you on the other end of this. Thanks.